Hello everyone and welcome to Financial Intelligence. In this video, I want to talk about why our brains are incapable of analyzing and predicting the stock market. As you know, the stock market is pretty complicated. Many new traders attempt to predict the direction of the stock market without using computer programs. Here, I'm going to share with you 3 reasons why we are not equipped to analyze the financial markets without computers. Number 1, multivariate nature of the stock market. Our brains are optimized for understanding simple single-variate problems. This is why we prefer to break down complicated problems into simpler chunks that we can solve individually. While single-variate analysis offers enough first-order accuracy in understanding simple systems, it is inadequate to solve most real-world problems, particularly something as sophisticated as modeling financial markets. Another tricky part about multivariate analysis is that in real life, often input variables are not completely independent of each other. The human brain is particularly terrible in performing any multivariate calculations where 2 or more variables are correlated. Unpacking the impact of each input variable on the response variable in these types of problems becomes super tricky. For instance, we know that both inflation rate and unemployment rate impact the stock market. We also know that inflation rate and unemployment rate are somehow correlated. In this case, performing a multivariate analysis by just looking at the historical data to infer how inflation rate and unemployment rate influence the stock market without using computers is very difficult. Number 2, non-linear behavior of the stock market. Another factor that makes analyzing the stock market almost impossible for the human brain is that there is a lot of non-linearity embedded in the system. The human brain is pretty good at understanding linear behaviors. For example, the relationship between the speed at which you travel and the distance covered is easy for most people to comprehend. However, most people have difficulty analyzing nonlinear relationships between key indicators and their impact on the behavior of the stock market. For example, the stock market behavior is governed by many positive feedback mechanisms that create exponential relationships between some input variables and the price patterns. Allow me to explain this by a simple example. Let's look at how the price of GameStop increased by 10x in 2 weeks. A lot of hedge funds had shorted GameStop believing that it was overpriced, essentially betting that its price was going to fall. Some investors came up with a plan over Reddit forums to buy the GameStop shares together and to drive the prices higher and create a short squeeze. In other words, they forced the hedge funds to buy back their shares, which in turn caused the prices to go even higher. A short squeeze is a perfect example of positive feedbacks that introduce non-linearity to the system, making it very difficult for humans to analyze. Number 3, dynamic nature of the stock market. Another complexity that comes into play when analyzing the stock market is the time dependency of the relationship between variables that influence the stock prices. What this means is that the relationship between input variables and observed behavior in the stock market is dynamic in nature and changes over time. For instance, today's economy is way different from what it was 40 years ago. Therefore, the correlation between inflation rate and the stock market performance extracted from the data that was published 40 years ago is very likely going to be different from what it is right now. Another important consideration here is that the behavior of the stock market depends to a large extent on the mindset of its participants, in other words, the traders. Since the stock market participants have been evolving over time in terms of their understanding of and their approach to trading, the stock market too has been changing over time as a result. For instance, 40 years ago, most trades were placed manually, whereas today most trades are executed by computers. As the nature of the stock market has been changing, it is very probable that the relationship between input variables and the response variables have been changing as well. Therefore, we need to take into account the time dependency of these relationships when modeling the behavior of the stock market. Of course, this makes it super difficult for us to perform such computations without computers. Final thoughts. In this video, I discussed how the human brain is incapable of effectively performing analyses that involve multiple variables, nonlinearity, and time dependency. Each of these complexities by itself is enough to make predicting the stock market super challenging for the human brain. In reality, these complexities are in play simultaneously, which means that analyzing and predicting the stock market without computers is almost impossible. I hope that you liked this video. If you have any feedback or suggestions, please add them in the comment section below. And don't forget to like this video and subscribe to this channel. Also hit the notification bell so that you don't miss any of our future videos. Take care and thank you.